All right, welcome back. It is now time for our weekly segment with Tech Trader, and I want to welcome him in. Good morning.
Good morning.
How are you doing this fine Monday?
Doing good, doing good. It's been a really good start to earnings season.
Yeah, for sure. I was looking through a lot of your names, and we've broken them down in our calls and whatnot, and I was just overviewing some of not only your longer-term portfolio calls, but some of your earnings calls as well. Before we get into that, though, one of the places that I always like to start with you is just, as a whole, where are we at in the Nasdaq? Are we getting a little top-heavy here, or you expect some consolidation on our way to new highs? Where are we at?
Well, I do expect consolidation, and I'll remind. So even in '99, as good as '99 was, well, in retrospect, it really wasn't good. It was crazy, right? So as crazy to the upside as it was, there were still pretty violent little downside storms, even in the bubble year of '99. And I bring up '99 because a lot of what I've written about that I thought '98 could be like. In fact, I thought the very late year sell-off that we had really mirrored and echoed 1998 a lot. Now don't misinterpret this. That doesn't mean I think we're going to have a '99 bubble again. And that doesn't mean I think we're going to see stocks come out in IPO like Akamai did at like 800 times forward sales. But things echo. In the market, things rhyme, they echo. What I'm really looking for specific, and we are seeing it in a huge example, really, from the lows, is I'm looking for a really notable catch-up rally in high growth stocks that are not the largest market cap stocks. So mid small cap growth, underloved value names, left behind growth names. Again, almost everything I look at, especially in recent. I mean, again, years ago, had we been doing the show in 2013, I was like all uber mega large cap, Google, Apple, stuff like that, because that's where the value was. That's where the value in growth tech was. Again, Carl Icahn was buying Netflix at, 35, 45 bucks a share back then, and the stock went 13 bagger. So now, though, the value and I've been harping on this since, January of last year, the value is not in FANG. The value is in stocks that actually have 2 or 3x the growth rate of FANG, or the same growth rate as FANG, but are trading at, valuations that are 1/4 of what the FANG names are, and that sort of thing. We'll probably bring this up later in the call, but I got a list. I put a list together for you of stocks that I was on early that did really well, that kind of are popular stocks now that I'm disinterested in. So again, that you can bring that up whenever you want, but I put a specific list of, I think it's 11 names and then 7 in particular that I was going to talk about. But I think as far as the market, here's where I am. I'm very content to ride the longs I have, and I have plenty of them. And I think a lot of the things I have a lot of upside, but I don't really want to add to much on the long side right now. I'm finding myself looking at more shorts. Now, at the same time, shorting, like anything you even try to short, doesn't work. You're like down within 4 hours. But that doesn't mean it's bad to do, because sometimes you can be down in 4 hours, but 4 weeks later you'd be pretty happy you have the short on, right? Either for a hedge or for just a profitable trade. So I'm seeing more short setups I like. I covered IGV. I can't remember exact price, I think it was around 160 even. That thing's like, where's IGV trading right now? 197. Okay, so 40 points. That's start. Again, in lieu of a market where I thought was a lot more dangerous short term, I'd already be short IGV. I'm still waiting. So I'm kind of just watching and waiting on a lot of potential short setups. So I don't. Again, the sentiment is not in a really crazy dangerous level, and you've seen me. I've highlighted those. It's elevated, but it's not spiking. So really what we're seeing is this is just the antithesis of how crazy the selling was either at the November or the December lows. And so you know, unfortunately, you know, people got stopped out in that period. That's too bad, because that was a terrible time to sell. It was a really good time to buy. In worst case, it was a great time just to hold your longs. And then if you held them for 4 weeks, you got paid back very, very well.
All right. So as far as your sentiment scores, where are they at right now in the Nasdaq?
Same thing. They're kind of like elevated, but not way overbought and spiky. So in fact, you know, again, the NYMO's trying to kind of roll over and cool off a little bit. Let me look at a couple other ones. The only one I pointed out, and I think it was in either my last note or the note before, the percent of stocks. So you can look at the percent of stocks above various moving averages for either the Nasdaq 100, the NYSE, or the S&P. So it's the same. It's a percent of stocks above 50, 150, and 200-day moving averages. And the 150 and 200-day numbers aren't too bad yet, but we're getting kind of hot. I think we're at 82 to 84% of all stocks are above the 50-day on the Nasdaq now. So there have been times we've had a pretty good sell-off from that level. Usually what happens, though, is you want to see some convergence. So you want to see, you want to see something like, you know, maybe 80% of all stocks above the 50-day. By the way, that's Nasdaq 100. 80 stocks above the 50-day, and you know, maybe 70% of all stocks above the 150. Right now, what we have is we're still kind of working off how crazily oversold we got. I'll give you the exact number. So as of Friday's close, it's actually 88. So 88% of the whole Nasdaq 100 is above the 50-day moving average. That's a high number. It's a very, very high reading. I can only recollect seeing 90% plus a few times. But that reading, so then the percent of stocks above the 150-day are 57%, which is relatively muted. It's not hot. It's not cold. So, but that is something that I'm just not going to buy stocks when I see 88% of all stocks in the Nasdaq 100 are above the 50-day. That just, you know, I might hold plenty of stocks, but it's going to be rare that I'm going to add to something. Unless it's Catalyst, unless it's a stock I've already said, hey, if IIVI goes to $36, I'll buy more. You know, unless it's something like that. Unless it's a trade I've kind of got planned out, and it's a tactical trade, a discrete trade on weakness or something. But, you know, put it this way: if you want to just be bullish, if you want to just say, hey, I'm just staying long until my trailing stops or new stops get executed, that's a pretty good market to shoot at. You know, I mean, we got a lot of momentum, a lot of stuff. I mean, I don't even know if there was news on Roku, and Roku's at 10% today. So we're kind of in one of those markets where people are kind of just saying, hey, let's party.
Yeah.
I mean, seriously, again, are we as silly to the upside as we were to the downside? Not at all, because the downside silliness was complete nuts in November, December, especially December lows. But, you know, again, we're kind of just seeing a reflex of as dumb as we were on the downside. There's some equally dumb sort of momentum trading now kind of occurring on the upside. It's not as extreme, but it's the same kind of theory. It's like, oh, hey, what went up last 3 days? What's at a 4-day high? Okay, I'm going to buy it. And again, hey, there's some people very good trading that way. I can make plenty of money trading that way too. I've just over time I've migrated. I still do some of that stuff, but I migrated to my own specialty, if you will.
All right, so one of the things that you've been able to do this earnings season was snuff out some potential winners in front of the print. You came out with WDC, Adtran, Facebook, just to name a couple of them. So I got to ask you, since we're still in earnings season, do you have any more up your sleeve?
Well, I mean, I think to me, it's always a weighted probability. You know, Seagate's probably going to be okay. Had a big spike off Western Dig already. I'm more like willing to kind of hold Western Dig. But yeah, I don't know. I mean, we'll have to see. What I'd rather see Seagate maybe have something to say that's not so good, and look to buy weakness in either that or Western Digital or something. But like that's probably the easiest call. Hey, if we see a reflex rally, a big stop rate or a big sell program on that name, you know, and it's down, I don't know, it's at $40 or 41. You know, that's probably a pretty high probability bounce candidate. The other one I think is kind of a no-brainer. You know what I always said I could be long this name. I just have other stuff I like better. But you know, I've always said sort of Google is I feel the best of the FANG names. Even when I was saying most of FANG was a screaming short, you know, I didn't really advocate shorting Google. So you know, I don't mind Google. I just think it's kind of a plotter. You know, I think I wanted to see Google kind of like between 850, 900, and I could have scooted up there pretty readily. But that, I wouldn't be surprised if they report a pretty stellar quarter. Fabrinet, I think, is going to beat handily. You know, stocks doubled. FN, Fabrinet's FN. Stocks have doubled off the 2018 lows, though. You know, that's another thing is, you know, I have plenty of exposure to fiber optics already. So, you know, I'm not the type that's like, you know, I don't have to own every single name in the group, especially when I already own about 70% of the names in the group. But I would, you know, here's what I think about this. You know, we've seen the big move out of Facebook. We've seen a really good move out of IIVI. Now, IIVI came off a low base. Sometimes what we see, though, is stocks that are coming off a higher base or even at a 52-week high actually will go up more. So like the spike in ServiceNow, by the way, ServiceNow is definitely in my short list. So the spike in ServiceNow, you know, that was 30 points. I think I wrote this, you know, I owned ServiceNow when it was a $30 stock. So just think about that. So I love the stock. I was long. I made at least 2 times my money. This was again 2012-13 time frame. And so, you know, so now we get a spike move. The stock moved as much in a day as you could have owned it at just a few years ago. So you know, I pay attention to things like that. I kind of think about things like, doesn't mean I'm going to act on that information that day, but I kind of just store it up. But yeah, when I see a stock go up, just the gain in one day equaled the whole price of the. In other words, they added as much market cap in one day as the whole company traded at. Just think about things like this. But the point is, why did ServiceNow go up so much? It was a good report. I think. I mean, there are plenty of times ServiceNow's reports have been every bit that good. But the reason it went up so easily is that just sometimes people want to buy stocks at high prices versus low prices, and they're more willing to bid up stocks at high prices. You have a whole theory, the whole investor business daily sort of mindset sort of perpetuates this. Again, I'm not saying it's good or bad, it just is. You know, a lot of times they're short covering. So if the shorts are in max pain, they might have to cover at exceedingly bad prices. So, you know, sometimes you'll see a stock actually spike and move a greater percent off of a high than a low. So if Fabrinet were to have a really good quarter, I wouldn't be surprised if it almost makes a bigger move from 50 than it made from, like, the last time I was long the stock. I want to say it was around 28. Caught a real good trade in this, by the way. But you know, it made a good earnings move off of like $28-30. I can't remember the exact number. But like I said, I wouldn't be surprised if it made a way better. You know, they have to deliver the number. But that one's interesting. The more interesting stuff, by the way. So LITE is Tuesday morning. I don't think LITE's going to have a good number. I actually want LITE to have a bad number. But if they really hammer it, I'm interested on long side. So that's something I'm looking at. Probably the one I'm the most interested in would be MTSI. You know, there's some clues. You know, IIVI was good, especially in core optics. SILCOM, SILC, that's the kind of name that most people aren't even going to know about. They talked up optics 5G. bandwidth, telco investment. There's another name in this space. Xilinx. Xilinx reported really, I think they had like 34% growth in their 5G type area. So, that's all right in MTSI's wheelhouse. So, I mean, again, at this point, I'd rather see MTSI say something bad so I have another chance to buy more. Because I have very, very high conviction in that name, but I wouldn't be surprised if they have a good point. Somebody asked that question. They said, "Look, I know you bought this cheaper, but would you buy it ahead of the print at 18?" And my honest answer is, yeah. If I didn't have any, I probably would. If I didn't own any of the stock that I currently have, I probably would. I probably would make sure I at least have a partial position in front of the print, and then hope it goes down.
All right. So based on some of the things that you're saying, like in LITE, MTSI, would you be willing to say...
here's another one. Sorry to interrupt. Here's another one. VIAV. VIAV. Very undervalued stock in the fiber optic space. They're more of a test and measurement company, but they have a 3D sensing filter and some other components that are sort of almost like at a global monopoly. There's like not much competition for them. That could be kind of like a stealth long. I'm long that name too, but I've been long that name for a while. Frankly, it hasn't traded very well. So the thing I kind of like about VIAV is that it's kind of due for a catch-up move. They can't miss. They need to have a good report. But if they have a good report, they're probably kind of due for a catch-up move. Anyway, go on with your question. Sorry to interrupt, but I didn't want to. That's another one that I kind of favor ahead of the print.
Okay, so it kind of leads into the question anyway. The structure of the particular trade, would you say the best strategy would be to buy, like, say, a half a position? And again, this is more for a trading time frame as opposed to a longer term investment that you typically have. Would you advise to put on, say, half heading into the print and then buy on any dips should the print come out and you get an opportunity to buy it lower and then hold it for a swing? Is that a fair way to assess it?
Yeah, I think that's a good way. It depends where I am. Anyway, a quarter, a third, half, something like that. What kind of depends on people and how they're positioned, how many other things they have. Everybody's responsible for their own personal positioning. But yeah, I mean, I tend to not do a half unless it's kind of my second or third piece. I tend to kind of do quarter, thirds. But see, for me, I'm basically full position on MTSI into the print. So the reason I don't want to add any is I've already got what for me is enough. And I always contain myself. I kind of make sure no one name is ever going to cause me too much anxiety. And I already got a pretty big fiber field bet. I've been talking about this thesis for at least a year. So yeah, no, I think, and here's the thing to not lose sight of. No matter what happens with the print now, you have to be. It's the trees versus the forest. Hey, it's always nice to catch a great quarter. It's always nice it's nice that IIVI popped, but I'm more worried about what's going to happen over a 3, 4, 5, 6 quarter run than any one discrete quarter. However, it's nice to have confirmation along the way, right? Because a stock's not going to do what, for example, a CyberArk did for me or a Splunk did for me over a 2-year period of time. They're not going to do it on one quarter, right? They have to put a string of good quarters together. So the company does have to deliver. You can't have a quarter a company just perpetually misses, and then one great 5G quarter is not going to make up for 2 years of pain. You know what I mean? So you really want to see consistency if you can. A lot of the names I operate in are cyclical, though. So sometimes cyclical names have runs, so they're not really consistent. Like a ServiceNow, I'd argue, hey, the reason it's valued as highly as it is consistency. Whereas a lot of commodity or cyclical names, the companies might be just as powerful. Their cash flow production over a 5-year period might be just as good. Cash flow growth might be just as good, but they're less consistent. So that sometimes gives you a much better valuation to kind of fish in. But yeah, I think you generally hit it. It does depend on the name, though, whether I want to be a quarter, third, half, whatever. But yeah, I mean, let's say you're starting fresh. probably half is the absolute biggest I would do on a brand new position. I'd probably do more like a quarter or a third.
All right. So as far as, let's take a look at some names that you have talked quite a bit about in the past, and we get a lot of comments about it. Got to bring up Qualcomm and where we are on this one. I know we're trading down here around well, sub 50. So would you consider this to be a high conviction name that you would buy? If nobody,
it's a very high conviction name. I'm I've been in this situation before where it sort of feels like it's me versus the world. In fact, I should send in a piece that I found just this weekend. I was kind of hunting around the internet and I found a piece about Facebook. It was when Facebook was $19, and there was like me and 11. It was either me and 10 or me and 11 other contributors. And I was the only guy that was bullish on Facebook at $19. And CNN Money interviewed me, was maybe 23 to 26 at the time, and I basically articulated the whole mobile thesis that Facebook was going to do. They hadn't done it yet. I don't even think they launched it. So, I'm kind of used to being kind of like the only guy in the world, even though you're not. It feels like you're the only person in the world that likes something when everybody else dislikes it. Vice versa, hey, I felt like I was the only person in the world who wanted to short NVIDIA in the FANGs and Micron and other stocks at highs. So sometimes people have a hard time doing that because it's very uncomfortable. I don't know. I'm kind of comfortable being contrarian, but yeah, no. I mean, I literally haven't changed my conviction at all. The FTC is something that's been, this whole thing with the FTC has been around a very long time. Now, the only issue is, does that mean I'm going to pile into it now? No. I mean, it's pretty much at my cost. My cost is 51 to 53. So, that's the one thing I'd say too. I put a really long note out on Qualcomm, by the way, just a couple days ago. Everybody can read it. But I think the one thing to kind of think about, it's when other stocks went down anywhere from 30 to 60% from August to the bottom on December 24th, Qualcomm didn't really go down very much. And I think people just don't like, it's frustrating now that so many names are working and it's not working. But they have an overhang. They have risk. Everybody's, again, the funniest thing about that short report, and I really hate giving credence to things like that, because my view is, hey, why doesn't the short have to kind of counter my argument about why I like Qualcomm, right? I mean, hey, why do those guys not have to justify why other people like it? So instead, they put out something that's whatever, and then everybody says, well, wait, hey, what do you think about that? It's like, well, why do I really need to think about something that I don't even know how relevant it is, right? But again, the funniest thing about it.
But isn't that the point of those short reports, to highlight things that maybe other people are missing?
Well,
that seems to be
yeah, if they're missing something. But here's so hey, if you point out that Sino Forest, Muddy Waters did a good job on that. If you point out that Sino Forest is pumping up the asset value of the company, you're pointing something out that might not be known. If you put out a short report and make it sound all inflammatory, but the short report's premise is basically consensus Wall Street opinion, that's pretty dumb. I mean, in other words, there's not a single Wall Street, and I've said this about 5 times, there's not a single Wall Street analyst that thinks the FTC is going to have a favorable ruling for Qualcomm. I've never once said I think the FTC is going to have a favorable ruling for Qualcomm. In fact, I'm kind of assuming it's going to be a bad ruling. We could go into a lot of theories about why the FTC wants to harm a U.S. company in front of a very, very important multi-year trade issue with China. And when we're talking about a race for global supremacy, I would think hurting a company that's one of the global leaders in 5G technology is very counterproductive to U.S. strategy. So again, it's just the whole thing doesn't really make sense to me, to be honest. But I won't publicly say what I think about it because I can't prove it. I can't prove what's going on behind the scenes. But the whole thing kind of just smells bad to me. But the bottom line is, yeah. So the short report premise is that the FTC's ruling is going to be bad. Again, that's what I mean, I could be wrong. Find me a Wall Street analyst that think the FTC is going to have this gloriously positive ruling for Qualcomm. I don't think there is one. I don't have one. I don't know any bull that's banking on a positive FTC decision. So you have a short report, which basically is, spouting consensus opinion. It's very strange. It's very strange that moved the stock at all. But we're in strange times.
All right. So if anybody didn't have it, you'd be very comfortable recommending at this sub 50 level.
I would, but you have to keep it in. You can't get so crazy on it that if it goes to 45 and stays there for 6 months, and then you miss a 99 type move in the market, you can't let it dictate how you're told your year's going to go. You know what I mean? I think there's a tremendous opportunity name. That doesn't mean I'm gonna have such a large position in the name. It prevents me from trading 50 or 100 or 500 other times, right? Mm-hmm. So, I mean, it's really that simple. I've made a lot of money in names that are unpopular, but at the same time, sometimes I'm not very active in them because the activity is occurring in other areas. So if you pile into something, even if it works, if it takes 4 years to work and it doesn't work that good, well, geez, opportunity cost is probably as important as opportunities themselves. So, I don't know. I don't think I'm saying anything that's that extraordinarily rare. But yeah, I mean, it's you just got to make sure you have room to operate in whatever other names you want to operate in.
All right. I'd like to get your thoughts on Apple, and I know you like the name for the most part, and I know you liked it when it dipped down there. I'm just curious, on a hypothetical level, where do you think the stock would be if Apple didn't come out with the pre-announcement, yet they put the whole thing in their earnings report with the Q2 miss and then the guidance that was on the low end of expectations? Where do you think Apple would be right now if that would have happened?
That's a really good question. I'm not sure. I'd have to go back and look at how much they actually really guided numbers down versus where they were previously. Remember though, I don't really like it. I mean, I thought it was once it went from 220 plus to 80 to 100 points down. Yes, it was. There's no way I'd short it. But I'm not long any, and I'm not. I've been very critical of their lack of M&A. Again, I just don't really think it's a short. But yeah, to get to your point, I don't really know. I don't really know. I'm also not sure. I'm not sure that we've. Put it this way. Here's the best way I could wrap up this whole. I don't know if really the time, and I've said this, that I don't know if all the pain's over yet. And again, I'm real. My single biggest concern right now. They're buying a lot of stock back. Their net cash is not increasing. They still have plenty of net cash, but their net cash relative to market cap when I was long the stock was way better than it is now. They're likely not going to have a 5G phone. So they're going to cede a lot of potential 5G sales to the Android marketplace. And I wonder if this whole issue with Qualcomm and trying to kind of bully another company, I wonder if that's going to have any long-lasting impacts against the stock. I'm not sure. I'm not sure about that. It doesn't really change my view of the stock at all. But I just, I don't really like that policy. My biggest issue, I mean, I literally would have never sold the stock had they been doing what I think they should have been doing, instead of buying so much stock back, is buying other assets. And again, more of the Google strategy, a little, or more even the Facebook. I mean, Facebook hasn't done a ton of M&A, but they've done some big M&A, and it's been smart. I mean, buying Instagram for $1 billion, that's almost as good as buying Google's buy of YouTube for $1.6 billion, which is still one of my greatest mergers of all time. But yeah, no, I mean, I think your question is a great question. I'm sorry, I wish I could answer it. I think it's a great way to think about it. But yeah, I don't really know. But the thing I would say is, put it this way, if you're long Apple, it might be kind of a similar thing to being long Qualcomm right now, because you're probably not going to get paid on Apple really well until they go into not this fall's iPhone cycle, but I'm talking the 2020 iPhone cycle. The 2020 iPhone cycle is going to be super good. So the question is, are you willing to wait? How many quarters is that away? Now the time that I usually like to buy it is 2 to 3 quarters in front of the new cycle. So like I want to be getting long Apple March, April, June of 2020. That's over a year away. So is Apple going? Are put it this way: are people going to be as lovingly? Are their views going to be as lovingly on Apple as they are now? Apple's gotten a lot of forgiveness. So we'll just have to see. I honestly, really don't think there's a reason to be long the stock for a while.
It's funny.
That's kind of where I am.
It's funny how you mentioned Apple bullying Qualcomm or bullying another company, because I was always in the camp that Apple got bullied into the buybacks by Carl Icahn.
It's amazing. I think we've talked about this before. It's amazing that Apple could get. Now I could see Apple getting bullied years ago when it was back $4 billion. No, I'm talking. I could see them getting bullied when they were on their death's door and they had to take $150 million investment from Microsoft. Right? Even then, they didn't get bullied. That was just a smart decision. That was sort of like a pipeline decision. But yeah, it's almost amazing that Apple actually was able to get bullied. But I really do. I really think that they were able to get bullied by Carl Icahn. It wasn't just him. It was him, and everybody had the view that Apple has all this cash,
and they're not doing
anything with it, and therefore they should do a buyback. And you know what? Hey, it goosed the stock for a short period of time. I actually think they made a huge strategic mistake, because if they would have followed my strategy and bought, let's just put a small number on it. Let's not say they did 100 billion of M&A. What if they just did 50 billion in M&A? I mean, just think what they could have done. I mean, again, sometimes small deals can pay off huge. But at a minimum, they could have easily added 10, 15, maybe as much as 20 billion in cash flow. Well, they do about 20-some billion in cash flow a quarter. That's not a meaningless number. I mean, but see, here's the point. If they consistently were to do what I thought they should have been doing for years, what do you have? You literally have the next Berkshire Hathaway. Which again, I think Google is pretty much your closest thing to the next Berkshire Hathaway. But Apple truly could have done it, because Apple produces way more cash flow than Google does. I just buying stock. Now, by the way, buying stock is great. So when hey, at 154 or lower, buying stock back is okay. Just like 3 years ago when the low was 92, buying stock back was okay. And just like 2013 when the stock split adjusted was probably 30, buying stock back was okay or good. I mean, you just have to look. You just say, look, is our stock better buy than other stuff we can invest? And by the way, that's the other thing they could do. Intel has a very successful sort of almost VC/money management operation they have for a long time. They've outperformed the S&P by by at least a multiple few hundred basis points over the long term, blah, blah, blah. Other companies have similar things. There's just a lot of things they could have done. There's a lot of things they could have done. The single worst thing that they could have done is probably bought any shares of stock back, in the top 25 or 30% of where the stock's traded. Because once you buy it back, hey, is the value still in the company? Yeah, it is. But guess what you have to do? You have to issue stock to get it out. That's pretty much what you have to do. So wouldn't it look weird if Apple started issuing shares? That'd look really weird. And would the price go up if they started issuing shares? No, that price would probably go down. So yes, it's a balance sheet. So by the way, a lot of people just don't know the accounting on it. You are adding value to the company, but here's the problem: you're only adding value to the company if the stock price stays at or above the current price. If the stock price goes down huge, that's why the huge value destruction has occurred in companies like Hewlett-Packard and IBM, where these stock buybacks of, again, 20, 30, 40 billion dollars of buybacks occurred, let's just say at 200, and then the stock goes to 100, right? Well, yeah, you pretty much lost 50%, just like buying the stock portfolio, right? So So is goosing EPS worth it for then harming your ability to go do strategic M&A? I mean, $100 billion of strategic M&A, that's a lot. I mean, look what Berkshire Hathaway has been able to do on, using something like 10 to 20 billion of cash flow a year. Now they make, I'm just saying that's if you looked at them over a 20-year period, they've probably done about 15 to 20 billion of M&A, most years over a long period of time. And look how big that company's become, right? I mean, look at Google. Google has an investment arm too. I don't know exactly how much Google has set aside for a combination of investing in M&A. But again, the Google M&A is just sick. I mean, DoubleClick, YouTube, all these things that they've bought that nobody's even heard of that have become products. Again, very good. There's so many things. I mean, I remember, for example, I think we talked about this. I don't want to spend too much more time. I thought they should have bought Adobe. Adobe it's still a very powerful software suite with professional Apple workers. Like I'm talking graphic designers and stuff, right? Like the core of the people who never left Apple, even in dire times. And Adobe's a very powerful software tool that has a very strong Mac presence and Mac lineage. And I mean, just think where Adobe would be today. Had Apple bought them, they'd be just as good of a company, maybe better, right? So just think about the value of creation of a merger at Adobe, circa 2012 or 13. I laugh at some of these things. Oh, they should buy Netflix. Well, hey, maybe they should have bought Netflix. Maybe they should have bought Netflix out instead of buying stock back, and they could have done an end around on Carl Icahn. I mean, that would have been smart, buying Netflix in 2013. I mean, they could have paid an 80% premium on 2013 and still got a very good buy on Netflix. And imagine if Netflix was an Apple company now. I mean, I don't think it would have harmed the brand at all. So anyway, we'll see what happens.
Yeah, but then we wouldn't have FANG. We'd have something else.
That's okay. We'd had some other acronym.
Yeah. All right. So... Any other? I
mean, here's the thing. Can I interject my focus list eliminations?
Yes, absolutely. And I was going to ask you which names you think are actually getting long in the tooth.
Well, okay. So here, just to backtrack. Okay, so if I look at what do most strategists do? Most Wall Street firms. So they have a focus list. Why are companies removed from their focus list? They're removed due to underperformance, typically, right? So occasionally they're removed because they've appreciated a lot, but it's pretty rare. Usually the winners, they keep them on forever because they want that winner to stay on the sheet so they can say, hey, look, we picked this and see how much it's up. Well, I don't do that. I remove stuff due to huge appreciation or excessive appreciation, really. So I think I put a list together here. Let me find it. So and again, my focus list has never been more than 20 names. Sometimes it's 18, but it's never been more than 20 names. So, and I've been with Briefing, about 2 years, or maybe a little more than 2 years now. So, and this is not a complete list. This is just the stuff I kind of thought of kind of quickly. But so these names were all things I favored over Apple, as an example. Anyway, I found it. Let me pull it up. So for example, okay, I was on every one of these names when either they weren't being talked about or they weren't nearly as popular. COOP, NTNX, Palo Alto Networks, Splunk, TWLO, MULE, Workday, Micron, PayPal, Akamai, Cyber. So I actually have removed, again, I don't think, this isn't all of them, but I've removed 11 out of 20 names due to appreciation. 7 out of those 11 names have been 2 to 3x plus movers. So when I talk about I don't really like Apple, it's because, well, guess what? Something I like right now is Pivotal. I think Pivotal is likely going to be a name, and this is just one example, likely going to be a name I probably end up removing due to price appreciation, just like I removed COOP and TWLO and MULE and blah, blah, blah. So the bottom line, I wanted to bring this
Pivotal,
up.
PVTL?
PVTL, yeah, PVTL. So PayPal. I mean, by the way, it doesn't mean I don't like these names. Although some of them I don't like. TWLO I actually think is a better short than long. I'm waiting for this next quarter. I think we could set up like that. Could set up like AOI did last year, or like Nvidia did last year, where they basically they have peak EPS or something close to a peak EPS type cycle, and and then have a very dangerous long. But I have to see the print. I don't have any position on it right now. You know, I still like NTNX a lot. I almost bought that in November, but I favored some other names. Palo Alto, I think, has been on my list twice. But like PayPal, still very much like PayPal. PayPal's pulled back. It just, again, I just some of these I just have to wait. I have to wait for price action, or I have to wait for something. But it's fair to say the things I have now. Hey, look, if I like PayPal better than I liked IIVI, PayPal would be on the list, and IIVI wouldn't be on the list. But I just wanted to bring this up, and I know we have a lot of new people, right? And a lot of new people trying the platform. But I think because a lot of times on these calls we spend a lot of time talking about the one name or the two names that people aren't happy with, or they're not working, like Qualcomm. Well, guess what? To have 11 stocks that have removed because of out of 20 out of excessive price appreciation, guess what? You're going to have a couple that just aren't going to work. There's no way to hit them all. I always say that. My record's pretty damn good, but there's no way to hit 100%. Well, there is. You could be Bernie Madoff and you could lie about it. That's the only way to hit 100%. But the bottom line is, so I try to focus on not what's happened, not, hey, let's make sure we're buying this exciting stock that's at all-time highs. My focus is trying to find, hey, what are stocks that could go to all-time highs that are meaningfully higher than what they are today? I have to bring that up, and I don't know, maybe people just want to stay in the now. They want to stay in what's moving today and why is it moving today. I don't know. I'm not really built that way. I'm thinking about, hey, what could move 50, 100, 200, maybe even 300% higher? Doesn't mean I'm going to ride the name the whole time. I mean, TWLO is kind of a bittersweet name. I was on that name, did very well, made a very nice return on that name. I mean, I missed a huge amount of movement in that name. Yeah, that's the other thing too. I'm typically going to be early on the buy side. I'm typically going to be early on the sell side. But yeah, anyway, I don't want to spend too much time on that. But when I look at this, so if I would have stayed bullish on Apple the whole time, how many of these names would have not been involved in? I mean, I know for a fact some of that NTNX money, some of the COOP money, some of the MULE money. I don't think PayPal. I don't think any of PayPal, but at least 3 of those names, I would have not have made 50 to 200% on had I not been out of Apple. And Apple hasn't risen 200% from 155 or 160 bucks. That's around where I think I ended up getting called out of most of my Apple in the mid 100. So hey, I missed some return on Apple, but I way more than made up for it in the names. I got a really good question on CyberArk the other day, asking me about, and I think it was sort of like, hey, how come you're not in this, and how come you haven't? It was a great question. I really respected the question, but I think it was more of a criticism of FireEye than it was sort of a talking, lovingly about CyberArk. It's like, well, I could be wrong. Maybe FireEye is going to be my perma dog, but from current prices, I believe FireEye has a lot more upside than CyberArk does. It doesn't mean I still don't like CyberArk, but I wouldn't have removed it from the focus list if I felt it still had 50 or 80 or 100%. I've been pretty good at this. I haven't removed too many names that have exploded. Twilio's definitely exploded from, well, it was on my focus list. I just wasn't long, the name is long, but it was on the focus list probably, I don't know, I can't remember, I'd have to go back and look. I want to say till at least the 75, 85 area. But it's certainly higher now. So, but that's the other thing too. I don't think, I wouldn't let this stuff bother you. I mean, you just, again, there's no such thing as trading perfection. The only way you can constantly be going after new names is you have to monetize old names. And if people just get too hung up, you either spend too much time worrying about the 1 or 2 names that aren't doing well, Again, you spend all your time focusing on that instead of focusing on things that you should be trading or investing in. Or you spend a bunch of time worrying about, oh my God, if I just would have kept that. Oh, why didn't I keep that? Hey folks, I owned Berkshire Hathaway many years ago, the A share. It's one of the worst 50-60% returns I've ever made. Because if I did, a single share of Berkshire Hathaway was it worth $400,000? I probably sold it at $16,000. So again, you just can't spend all your time and energy thinking about that you would have had a perfect hindsight or you would have had a perfect vision. There's just no way to do it. So anyway, not to spend too much time on it, but you got to be present. You got to think about what you want to do. Anything that you've done before can't be undone. Anything you've already done, you have to move forward. So, words of wisdom there. Just make sure you're trying to focus on what you're going to try to excel on going forward. You can't really change anything you've already done.
All right, you already brought up FireEye, and that is on my list of listener questions, so let's jump right into that one. The question is actually, how do you like it heading into the print? Is it a buy here?
I like it. I am not buying more of it. I already have it. So if you believe in the theory that anything you're long, then you're essentially you would buy today. Yeah, that would be my view. I don't think they report though. I don't. I'm kind of focused on. We talked about the next 2 days. They might report Thursday, unless maybe Wednesday.
February 6th.
I'm looking right. Okay, yeah, they report Wednesday. Yeah, no, in fact, I mean, again, we talked about this. To me, this is a stock that has a lot of pent-up energy. What I mean by that is they really should have already moved more. Twitter was just like this in the high teens. They put in like 3 good quarters. I thought the stock should have been trading at minimum 25 and maybe more like 35. This was a couple years ago, and the stock was stuck. It just kept stuck. Well, they eventually broke through, and they finally. I've seen this a lot too. Sometimes a company will actually break out into a higher price area. One, due to market conditions, a lot of stuff is moving right now. So maybe this is the kind of market where FireEye can finally make a break higher. Or sometimes companies don't have as good of report as prior reports, but it's good. It's still good. And so I've seen this a ton of times, by the way. You get that 3rd or 4th good report in a row, and maybe a report that was way better, the stock didn't do anything on. But you have a report that's less good, but it's good enough, and the stock explodes. I mean, I could almost argue that the Google, the last 50 to 80% higher on Google, have been on reports that really haven't been that great. In other words, to me, I thought the Google reports of 2015 through 16 were way better than most of the Google reports of 17 and 18. Yet look what the stock has done. Stock's done better in recent years. It's definitely done better on a much lower revenue growth rate. So, sometimes companies just have to work through it, and they finally kind of get their due. I mean, FireEye is way overdue for getting their due. That's the best way to say it.
All right. So the next one is.
Let me say one thing too. CyberArk was every bit as frustrating as FireEye, and another huge winner for me was HDP. I'm not talking HDP but that got bought by Cloudera. I'm talking the HDP of 2016, where Hortonworks was literally $6 to $8 stock for again a good report. I mean, 42, 45, 48% revenue growth rate. Stock didn't do anything. Then what did it do? In basically a 6 to a 12-week period of time, it went from roughly 10 to 21, tripled. Well, tripled off 7. It more than doubled off of 10. I guess it had kind of plotted its way from like 7 to 11, and then it burst from 11 to like 22ish. CyberArk did the same thing. CyberArk had a ton of good reports that were not rewarded, and then you basically had a 2-quarter period where the stock doubled. And that's where I ended up selling out of it. So FireEye could kind of set up like that. Anyway, what's the next one you were talking about?
So the next one is VKTX. The listener thinks that this the chart has a lot to like about it. Do you cover this one?
What's the company?
Viking Therapeutics. So I thought it was a tech name, but it's Viking Therapeutics.
I'm not sure I've even ever looked at it. I've probably seen the symbol, but I don't think I've even ever looked at it.
Okay. Well, throw it on your radar. Maybe we'll circle back on that one because I
Well,
know that
here's
you
the
do
thing.
like
This
to
is
look
why,
at.
hey, a listener brought up Tesaro last year, and I kind of looked at Tesaro a
And
few
asked
times.
you a bunch of times before you did it. It kept
Yeah,
hitting
well,
it. Kept
I never
asking.
did get long. I never did get long Tesaro, but at some point I said, you know, I like the name, and I could buy it here. You know, my biotech longs have done pretty well. Like I liked ICPT when really nobody did. By the way, ICTP, that's a focus list name of mine. That got an upgrade, or it got a price target bump to 185. My price target's 125. By the way, my price target's 125 off of a base of 61. Yeah, I might have to review my price target, by the way. But no, I mean, so somebody literally brought up Tesaro, and Tesaro, they had an approved drug. So I didn't know the company. I knew what they did. I knew what space, and I'm pretty sure it was oncology. Blah blah blah. But basically, I was like, damn, look at that thing. It's kind of, I can't remember what. I guess Tesaro's chart is gone now. But I want to see
I think
that
they
thing
got
was like a
acquired.
two. They got. I didn't think the stock was gone yet though. Anyway, they went from like 250 to like 40. And now the first question might have been more like at 65, then 55, then 45. But hey, you know, as long as his cost basis wasn't above 72 or 75 or wherever they got bought, that person got paid. So yeah, now Viking Therapeutics, I have to look at it. Usually the ones that I kind of have looked at, I tend to look at a lot of the biotechs I think that have promising pipelines. That name just doesn't ring a bell. So I don't know if that. By the way, if it's a penny stock or if it's under 100 or 200 million market cap, those are some I tend not to look at those. So if it's really low market cap, I don't know if it's going to come across my radar. Anyway, go on, Jim, my man.
All right, let's see. So, for what it's worth, you were asking about some news on Roku. We just something that hit the in-play page. Roku Strength attributed to a report that Comcast will move forward with a Roku-designed smart box instead of an Apple TV platform, and also abandoned plans to create its own TV OS app. So, we're seeing Roku up. Let's see now, 10%. Maybe it's a little seldom news now. I don't know.
I try to stay so again, anything we haven't done previously we can't undo. Doesn't mean we can't get. Roku's starting to kind of irritate me because I don't own any. You know, so I like this. I had this lined up. I bought other things, but yeah, that darn Roku. But you know, I'm just gonna wait. It'll probably give me a chance to buy it again.
All right, got to get your thoughts.
Congrats to people who were buying this, you know, 35 and below, though. Great job for those who did.
All right, so got to get your thoughts on Twitter earnings and any opinion.
Yeah,
on
Thursday morning.
All right, go ahead. Let's just stick with Twitter for now.
Oh, well, okay, Twitter for now. So yeah, Thursday morning. Again, my view on Twitter is still the same as far as an investment standpoint. I think it's an undervalued asset. I think it could go meaningfully higher. My price target's 51. By the way, that price target's been 51. You know, I had a 44. The 44 price target on literally was my price target in Twitter when it was a $14 stock, or when it was at lows, whatever the lows were. I haven't really raised it very much, but you know, it's been. You know, they're about ready to start thinking about the net. So in other words, they're about ready to turn. So the out year is the next year out. So you know, so sometimes stocks can re-rate higher when people just start looking at the next out year. That's going to be pretty close to happening for Twitter pretty soon. I just think, again, Twitter is. I don't think people understand or fully realize the power of the platform. You want to talk about a company Apple should have bought Twitter. I mean, they had 2 years to buy Twitter. To this day, don't know. To this day, don't know why they didn't do it. I know why Google didn't buy them, because they couldn't. They knew they'd have a huge DOJ problem. So you know, everybody always just say, oh, Google or Facebook's going to buy Twitter. And what I say, no, they can't. They'd love to buy. They'd love to own Twitter. They can't buy it. The two companies in the world everybody thought was going to buy Twitter literally can't buy Twitter. It's anti-monopolistic DOJ issues with that. Apple could have bought Twitter. By the way, Apple should have bought a bunch of search technology as well too. I'm not saying they should have bought an old tired search engine, but there's definitely they should have invested billions in search technology, and they have invested probably billions internally in search technology, but they never bought a search platform. But yeah, I mean, I like Twitter. I mean, I think again, 51. I think either a quarter or two could go by. I think the thing that nobody believes is that the revenue, so the current year-over-year revenue, I don't think anybody believes it's sticky. Meaning that Twitter can sustain a high teens, low 20s growth rate. In fact, the analysts for the next year out only have 13% baked in, and Twitter just did 29% year over year. So, if Twitter keeps growing more like 15, 18, 20, or 25%, at some point stock's just going to have to be traded a lot higher. The other thing with Twitter is Netflix garners this very, very high valuation. A lot of these companies have garnered very, very high valuations on themes. I don't know if this is going to happen because we don't know until it's happening, but if Twitter ever just garnered an excitement premium, I don't even know where the stock could trade to. But it really, if it trades and garners a heavy discount, it does not trade at any kind of a premium. So now some people might disagree and say, oh, Twitter's expensive. It's not expensive. It's on revenue metrics, on price sales metrics, especially on cash flow metrics, it's actually pretty cheap. They're a very, very good cash flow generator. And they got, what is it? It's a very, very healthy cash flow yield. So on some traditional valuation metrics, the only metric kind of looks expensive on is right now, like current price of sales, like on current year. But again, I look at out year. On out year, it's not that expensive, especially on my assumed growth rate, which, my assumed growth rate's a good 5 to 10% above where the analysts are right now. So the analysts are thinking they're going to grow 13% for the next couple of years. I think they're going to grow closer to like 18 to 22%. So if I'm right, you're going to have a bunch of analyst targets that are going to have to come up a ton.
All right. So same listener wants to know your opinion on Tesla, and then a couple others, Groupon and Trivago. So let's start with Tesla.
Tesla's honestly, I almost think Tesla's just a stock to kind of ignore. Doesn't do that much. It's been stuck in the trading range. I mean, if you want to play around with some shorts, you can. I don't think it's much of a long. No, it's been a pretty reliable long when it has these pukes down to like 250. I mean, it seems like every time it goes to 250 or below, it tends to go up. But yeah, to me, there's way more productive uses of time, frankly, than to trade Tesla. Unless you get a particularly good cadence on it. What I mean by that is some people get really in tune with the stock. They're good at buying the lows. They're good at selling the highs. Like I've got just my Micron. I just tend to see Micron very, very well. I tend to buy it when it's cheap. I tend to sell it when it's expensive, or even short it when it's expensive. I tend to trade it well. Some people are good at trading certain stocks. I guess if you're good at trading Tesla, trade it. But to me, it's almost a stock. It's kind of become a waste of time. I said this, I think, last time we were on the phone. I do think competition is coming, and my ultimate bear case has nothing to do with the fact that Tesla's got to repay a bond payment or something. My long-term bear case on Tesla is all about competition, and the fact that once you get Porsche and Mercedes and even GM are just better companies producing better electric cars, I think Tesla's going to have a very hard time selling the number of cars they sell now, or selling the cars at the same premium prices that they do. But yeah, I almost think it's kind of I think time is better suited on the stocks that are moving or are much better values and things like that. So I don't know. Tesla is just kind of almost becoming kind of a stock of disinterest for me.
Well, I know Groupon and Trivago were names of interest for you, so let's talk about Groupon. Yeah,
so in fact, it's interesting. It's so funny you mention this because I'm looking at this. There's a chance. I guess if people want to jump in front of me, they can. I may add more. I'm definitely going to keep what I have. Trivago. I'm definitely going to keep what I have into the print. I'm kind of tempted. 550. I'm kind of tempted. I have no particular feel for if this next quarter is going to be really good, but I do think thematically, just given sort of things going on in that industry, I think it's just going to be, things are going to get better for them. I think their growth inflection is going to. I mean, it's been a pretty good stock from 4. You know, I've caught this pretty cheap a couple times. But yeah, 550. You know, I think for me it's more of I'm looking. In fact, I'm looking right now. I'm looking. The chart is tempting to me. So this is not. It's not really an earnings call. It's more that the earnings could be a positive catalyst. But I really kind of just like the chart. So I don't know. I might post a. It's possible I'll post it. I'll post a buy on it. I'm certainly not going to sell what I have. I certainly have some, and I'm going to hold what I have through the print. What I probably should do is just let them print, and then hope I get weakness. I mean, again, the one thing I don't like, I don't really like buying a lot of new stuff given where the market is right now. Again, you know, in a market that a ServiceNow goes up 30 and a proof point goes up 10-15%, and you know, I don't know. It's just I'm not really wanting to add to a whole lot of new longs. Now, if you give me a quarter where they attack something on, you know, they really raid something lower, that might set up. But again, 550. It's pulled back $2 off the highs. These low price stocks move around a lot, but hey, it's better buy at 550 than it was at 750.
And Groupon?
Groupon, I'm probably not. I don't know if they report. You know, I added to this stock higher. I'm kind of starting to sniff my cost basis on it. I kind of bought this just as a very, very cheap asset. But you know, as cheap as I thought it was, between 4 and 450, it went down from there. But again, these low price stocks, you got to give them a lot of room. You know, I think I value this to like 10 to 15. I mean, this is kind of like my long term. So this is not one I'm not really worried about trading this long term. I literally added this as a name that I think could trade materially higher. Like again, it's still, if it went to 10, it would be a fundamentally cheap stock at 10. You know, would not be an expensive stock on valuation at $8 to $10. So, you know, I'm kind of just playing this as sort of a long-term thematic, kind of almost like a deep value long, and giving it plenty of time. I don't really know that they've had any bad reports since I've owned them. They just, you know, they went down when the whole liquidity rate happened in November and December. I mean, so if there's a reason to like it, it's because it hasn't gone up as much as it went down. So it basically went from 450 to 3 on nothing more than just algorithmic selling pressure late last year. I mean, it literally peaked out pretty much when the FANGs peaked out, or when NVIDIA peaked out late summer. That was the high on Groupon. And the low was either November 20th or December 24th. So there really is nothing to this other than, you know, this name kind of got, I think, overly victimized by, you know, the massive machine raid that we had at the end of the year, and the de-risking that tons of professional money managers did at the end of the year. And, you know, again, I've talked a lot about the conditions that created the hugely opportune prices we saw at the end of December. You know, the problem is you can't buy them all. I mean, percentage-wise, this stock's acted about as well as any of the stocks I did buy or the stocks I held. But no, I like it. Like I say, I think, you know, if it does go to 8 or 9 or 10, it'll still be a relatively cheap stock. The research I've done on, just to get a little more in the weeds on my fundamental view, I think Groupon is becoming more of something that's being used as part of people's habit. Meaning, and that's a lot of times when you really see technology inflect, is when something goes from being kind of like, oh, I'm going to try this now and then, or oh, hey, there's a particular Groupon or coupon that looks attractive, versus, hey, I'm looking at my Groupon emails every day. I'm thinking about if I'm going to, and I'm talking not me, I'm talking the greater number of people are doing this. You know, hey, maybe I should look up the Groupons to try some of these new restaurants. you know, hey, are there any Groupons I could take advantage of for weekend trips and blah, blah, blah. So in other words, I think it's starting to be, I think the usage, the penetration thing, the TAM, the things that I focus on, I think are all improving for the platform. So that usually creates a situation. One, you have an undervalued stock that plays catch up and goes to a higher valuation, even if their numbers don't improve a whole lot. Two, the numbers improve and force valuations higher. Or three, the company gets bought out. I love situations like that, and they're good for me because I don't need things to work on a day-by-day basis. So, but that's kind of the path I see. I think either the valuation can rise on roughly the same results, or they improve their results, or the company gets bought out. I don't really like. I don't see a risk of them going away. And we've talked about this. They've withstood the test of time. Everybody is trying to go into this business. I mean, everybody meaning Google, Facebook, Yelp, you name it. They have been attacked by everybody and they've survived. So the survivability is very high. They just need to do something to get people excited about the stock.
All right. Another listener wants to know, is Xilinx the go-to 5G stock?
Yeah, some people think it is. I don't really think it is. It's a nice company, but it's probably become the most expensive semiconductor company now. Generally, the thing I am almost rarely now that I will be in or have been in the most expensive stocks if they just happen to trade to that point while I still own them, but I certainly don't buy them with fresh money. So I just don't think the valuation on Xilinx is compelling. This is an example of most people that I see do this kind of trading are losing traders. They don't make money. So if you're constantly buying the hot dot, generally my guess is you're constantly getting stopped out. And if you're constantly getting stopped out, you're probably not a profitable trader. So I tend to avoid that behavior. I don't think buying the hot dot, again, buying Apple at 220, buying Facebook at 220 plus, buying NVIDIA at 285 to 300, buying AOI at 95, buying Acacia at 125, on and on and on. It can work. It can work until it doesn't. But it's, I think some people also think there's a lot of protection in well, I'll just get stopped out. Well, that works if you don't have to gap. But if something happens and all of a sudden you have a gap, your stop doesn't execute at your stop price. It might execute 10% below, or 20, might execute 40% below your stop price. So yeah, I think it's a fine name. I think they had a very good quarter, but hey, I'm not going to buy it with my money. There's no way. And I might even short this. I actually think the setup for a short, because here's all I need for a short to work. I'm probably not going to short this for the next two prints, but I might short it between the prints. So what I mean by that is all I need for a Xilinx short to work is I just got to catch a Nasdaq sell-off. Now notice, you know me, how many times I say, hey, I think Nasdaq is going to drop 700-800 points. Blah, 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 blah. I caught most of those last year. I am not saying that right now, but I can almost guarantee you the next time I tell you personally or write a post and say, hey, folks, I think we're here again. I think the Nasdaq's due for 500, 700, 800, 1,000 point header. I think Xilinx probably be shorted because that's all I would need for a Xilinx short to work is the Nasdaq to drop. That's all I need. So I just have to wait for a time where I think, I want to be more short than long. Or I want to have more short exposure against my long books because I think the probability for a correction is higher. So I think that, the next correction, that's why, put it this way, if you're hell-bent and you want to buy Xilinx and you just think it's the greatest thing in the world, do you have to buy it here? I'd rather buy it, on a retracement of at least to 100 or something, and a better buy would be something like an 88 to 92. That would be a better buy. So, we'll see what happens. What happens to a lot of people think, you have to understand semiconductors. There's very few semiconductor companies that build really, really sticky, durable leadership positions and go unchallenged. there's plenty of competition to what Xilinx is doing. There's plenty of other semiconductor companies that are very good. There's multiple FP field programmable logic companies. There's plenty of companies selling data center enabler tools. There's plenty of companies that are in the 5G space. So, you know, it tends to be, hey, how long is the leadership position on a product that you've got? How sticky is your IP? It's funny, again, what's really funny is people are attacking Qualcomm so much over IP that there's no argument that their IP is not critically important IP. People just want to buy it for a way cheaper price. But you know, we'll see what happens. Like I say, there's other names. I would say I'm pretty confident on names like IIVI and MTSI and Acacia. I would say from current prices, you know, I'd be pretty surprised if most of my companies don't outperform, you know, outperform Xilinx from here, or even from, you know, 88, 90 bucks. I mean, MTSI, what does MTSI have to do to give me 40, 50, 60, 100%? It doesn't really have to move that many points. I mean, if it goes to 36, there's a two-bagger. By the way, and that's from here. I mean, the stocks run. I think my last buy on it was under 15, 1450-ish. I want to say, and that wasn't even at really the lows. I think I caught that. I don't know. It was within a few days of one of the lows, the November, but it wasn't at it. I mean, I could have caught it better. So you know, they've already gone up 4 points, and they've barely moved. I mean, there's a big gap fill on this thing between 23 and 27, 28-ish. You know, and this was a pretty popular stock that easily traded into the 45 to 60 range. And that was on the 4G cycle. And I would arguably say that MTSI has a better 5G portfolio than their 4G portfolio. So it's kind of that simple for me. That I think my basket of fiber optic 5G bandwidth enabling technology companies, I would be surprised if most of them, there'll probably be one or two that don't outperform Xilinx, but I think most of them will. And I think the ones that really outperform it will be like magnitudes better. So yeah, hey, put it again in a mini 99 echo scenario, almost everything's going to work, right? Shorts, so people who are trying to short will look dumb, and they'll have to face humiliation for their short calls. and you know, all longs will work. Well, but in that kind of a market, what longs will work better? A long that goes up, an exciting long that sounds good, like, oh, Amazon went up 300 points off of a blah, 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 blah. Okay, well, that might be a 15 or 20% move, but a stock that went from 14 to 50 or 14 to 40, that's a much greater percentage move. Again, Roku. I mean, I really should have been a Roku. I think the day it was trading, and it traded lower than this, but I was really close to buying. There was a day I was sitting there looking at, like, I want to say it was like 31.80 to 32.50. I came really close to buying it. I mean, you know, a stock I haven't had any questions on recently, probably because the stock's popped 40%, is Cloudera. So it used to be tons of questions on this thing at lows. Now there's not as many questions on it. Again, Cloudera that wouldn't have to do that much to really outperform Xilinx, just based on where it is, how cheap it is, the valuation of it. You know, it's a pretty fairly valued stock at 20, and it's still 1380. So you know, a move to 20, that's a heck of a lot of percentage points. You know, Xilinx would have to go, I don't know, you know, to 180. I don't know. I think the odds stack up pretty well for some of these names. And again, you know, doesn't mean I necessarily like low price stocks. I like stocks that are, you know, on the lower end of their trading ranges, whatever those respective trading ranges are. So you know, there's might be a high price stock that's way off of highs. You know, by the way, total non-tech name, I was looking at Mohawk the other day.
MHK.
Like Mohawk, yeah, MHK, like something like this. You know, 280, 300. By the way, this is one of the best companies in the world at what they do. They might even be the best company in the world at what they do. It's just their end markets aren't very good right now. But, you know, way below the 016 lows, even lower, they even broke the late 14 lows. Yeah, okay, below the 14 lows, they're not. I mean, this stock, though, was a monster. This was I mean, I remember when Mohawk was $40, $50 stock. So, but I mean, look, I'm a tech specialist, right? I like tech, I like biotech, and then I like finance kind of third, right? And I love finance names too. But hey, if I'm looking at Xilinx, I'm just going to pull up the chart of Mohawk and go, you know what? Maybe it's time for me to own a non-tech name with some of this money. And I mean, I'd rather own Mohawk than Xilinx. I think, you know, anybody wants to make me a friendly bet for the next 18 months, what does better, Mohawk or Xilinx? You know, I'll do a friendly bet all day long on that one. So, you know, things like that. Another stock, PRGO, PRGO. Again, you know, if I had a generalist focused list that was not particularly focused on tech, again, PRGO 46, Xilinx 110, probably going to go PRGO. I don't necessarily even really like this name. I just don't think it should be traded. By the way, I hated this name at highs. Absolutely hated it. I thought it was a complete, again, pretty much was right. I called it, was a total bubble type deal. Well, what happens to bubbles is they get typically, but by the way, this is, we could, not to get long-tailed here, but this is what could happen to some of these FANG names in another year or two. I mean, what if their growth doesn't resume? So you got to be careful in stocks that get way over their skis, because these kind of things happen. You know, a stock. I mean, there was a time when PRGO was like everybody felt they had to own PRGO. I don't hear anybody talking about having to own PRGO now, but you know, at 45, I think it's pretty attractive. And I don't even know the company that well, but I know enough to know that it's a pretty high probability long from here, if you have time. That, you know. So anyway, again, I'd much rather be in Mohawk than Xilinx, put it that way, long. And there's a good chance I might. Now, the Xilinx lineup is one of my favorite shorts. That's a tough one too, because I am, as you know, I'm super bullish on 5G. And I've been super bullish on 5G for like 8 to 12 months. So, you know, I'm typically early, and then the things inflect, and I ride the thing for a year or two or three. I don't know if I want to really be a long-term short on Xilinx, because they could be a strong 5G player. But I might not mind shorting them between the quarters, between the prints. But things like VIAV, I mean, Ultimate Software is incredibly bought out today. That's a whole nother subject. But things like that, Adobe, VIAV, AYX. You know, wait for the print on AYX. That could be a good short. You know, the really expensive software stocks that frankly didn't take that much pain, or whatever pain they took in late last year, they've already recovered it. I think that's kind of I think that's a move that will get repealed. I think you know, that the stuff that didn't take the pain late last year, that didn't sell off with their peers, you know, the next go round, the next big sell off, they'll be the ones that'll be targeted. So there's a whole list of software names I like. Again, IGV. Look at, I mean, again, I covered that thing at 160. I didn't short this perfectly, by the way. I mean, I missed my initial short, was easily 20 points too early, but again, that's okay. It still paid off nicely. But 197 is, I think, is 10 points higher than where I shorted it, my initial short on IGV. And that was calling the correction right. That was calling the downturn right. That was calling, you know, 1,100 plus points of Nasdaq decline correctly. And yeah, IGV is 197. So I'd much rather short IGV than Xilinx, I think. I don't have a reason to buy Xilinx.
All right, so I'm going to wrap it up after this one. The last question is, do you agree with buying Qualcomm options 1 year out? If so, what strikes?
Yeah, no, that's fine. I mean, I have the June 60s right now. I'm underwater on them. I even said I have no idea. I think they might work. If they don't work, I'll do the Januaries of the next year at either the same strike or a lower strike. Probably a lower strike, because if the 60s don't work, that means nothing good has happened in the interim, and then, you know, the stock's probably the same price or lower. So I get a crack at a lower strike price. You know, I'd probably go for the 55s right now. If you're going to go, let me just look. The one thing I will say about the Junes, I like the setup because the options, I mean, even when I bought them, the options were cheap, and they've gone down 50% since. Let me look at the Jans. I don't know. Yeah, probably 55. You know, a lot of it you just have to, you can also set up a spread here. To cheapen these up, you could set up a spread. I typically don't like doing spreads super long out though, because if you get a big burst of movement in the near term, the problem is your long, your spread, the short side of your spread will go up a lot. So it makes it hard to monetize the spread. So let's just, tactically, if you had a 50 by 70 spread or something, the problem is if Qualcomm goes to 70 or 75, that 70 call is going to explode. So yeah, you're going to get paid good on the 50 or the 55, but the 70 is going to go up a lot too. So you're going to have to ride that spread and let time decay work for you on your higher strike short call. But yeah, I don't know, 55. I mean, $3, $2.50 to $3 for 55s. I mean, that's not a bad outlay. But what I would say is you have to be prepared. If you're going to do that trade, it can't be a discrete trade. I think if that's your theory, I think you have to have a view like me that, look, I'm willing to try this call trade, a few different times. And I think, all I need to do is get paid. By the way, this is part of my prior playbook I've done on many stocks. I've done this on Apple multiple times, done this on Google before. But I did this to very good effect on Apple in 2013. I bought longer dated calls. My view was that if they don't work, I'll just roll them up or out, or roll them down and out. Most of those worked. I did have one like a 3-month or a 5-month period of time where it didn't work. Apple made a very strong surge initially, and then I think they had about a 1 to a 2 quarter period where they marked time. So I did have a couple of those that didn't work, but man, for 18-month, 2-year period of time, I bet I made money on 75% of my call positions on that. And it wasn't these were not 40, 50% trades. These were like 6, 7, 8 bagger type trades. And again, that was like literally Apple. That was like a generational type setup on that name. So we'll see, but yeah, I'm in the 60s right now. If I were to do my trade all over again, I would easily be able to buy the 55 strike. So I'd do the 55s because that's pretty. I mean, here's an interesting statement, or just an interesting, I guess, observation. We're talking about a stock. It's only 10% away from the 55s are only 10% away. I'm showing 130 to 135-ish, 130, 140. Seems pretty low premium. So you know what that's telling me? There's like nobody that believes. There's nobody that the players all believe that there's no hope for Qualcomm to make a material rise. I've seen a lot of setups like this actually work in perverse manner, meaning, everybody's on the same side of the boat trade. So if everybody's negative on it, and they're all banked on a decision that's basically a consensus call, I don't know. It's pretty interesting. So, but again, doesn't mean I'm going to go crazy on it. Doesn't mean I'm going to make it a materially larger position than my other favorites. I mean, I think I've told you this. I try to kind of weight a multitude of my positions at roughly equal size. I don't like put 1 or 2 positions that have with huge weights on them, and then have 10 other positions that are so small that even if they go nuts, they don't really help me very much. I'm pretty accurate, as you've seen. I mean, I hit a lot of these names. So my view is, look, if my hit ratio is high, I have a high percentage chance in getting a lot of trades right. Therefore, it makes more sense for me to have a few more trades at roughly the same position sizes, as opposed to trying to not having very many good ideas and trying to score on a small number of trades. So concentration is very tricky. You hear a lot of things about people concentrate positions, do very well in that. You also hear a lot of people blow up. I'd just say this: hey, look, if you're going to concentrate, you pretty much are putting yourself in a position where you're going to have to be right. Because the other way to say it is that, to me, there would be nothing worse than getting a ton of your positions right, a ton of your views right, and not making any money. You know, you catch a huge bull market. You have a buy list of 20, 30 names. 85% of those names work, and yet you have a flat to a down year. Well, why would you let that happen? The only way that happens is if you happen to just be unlucky and have way too much money in the one name that doesn't work. So therefore, why let yourself be in that position, right?
All right. Well, we can certainly check back in. I guess that puts you on the docket for a year from now. We'll check out how those Jan 55 calls worked out. How's that sound?
Oh, that's fine. Like I say, we'll see. I mean, hey, to me, it's not over. I'm gonna see how this thing trades. Next few weeks. By the way, I don't think the quarter was that bad. I mean, this is a quarter where tons of Chinese people aren't paying them. Apple's not paying them anything. So they're still doing 4.8 billion. I think that was the revenue number. They're not getting paid, I don't know, something to the tune of $1 billion plus of non-payers per quarter. They still have plenty of cash flow. They still have plenty of EPS, and they missed the revenue number. So, here's the other thing I was going to say. I don't know if I'm ever going to write a piece up on this. Do you have 2 more minutes, or we have to hop? Maybe we'll save it for next time.
No, why don't you go ahead?
I don't know. This will be a brain teaser.
Well, then we can check back in if it's.
We'll put it this way. Sometimes everybody's worst fears ends up being something that's not that bad. And what I mean by that is, so here's a good example of what I'm going to go into. Okay, so Twitter. What was the main reason Twitter didn't grow revenues for about roughly a 1 to 2 year period of time? Wasn't that there weren't ads on the platform. It's that they dramatically lowered pricing. Twitter lowered pricing year over year by something like 65 to 80%. Yet isn't it interesting their revenue stayed flat? Well, what happened? Their pricing became so attractive that a lot more people ended up using Twitter advertising. And now one thing that could happen, this is one of my Twitter theses, is that what happens if nobody's talking about Twitter raising prices again on an increasing volume in ad sales. If that happens, that you're talking crazy magical things happen for Twitter. Well, what if, Qualcomm's biggest issue is non-payment on existing royalties and existing agreements, or people just using their technology, not paying them at all, period. Like China has this huge, they just signed a $150 million per quarter contract with Huawei. Huawei has been a non-payer to Qualcomm for I don't know how long, a long time. I mean, how many billions of dollars does Huawei theoretically owe Qualcomm? Who knows? It's probably a huge number. But they've signed an agreement. It's $150 million per quarter in the interim until they hash something out. It's probably a bigger number for Qualcomm, by the way, once something gets agreed to. So, but let's say this bear thesis. This toxic bear thesis that, oh yeah, they're going to have to lower their IP royalty rates a big amount. Well, what if it's like Twitter's ad rates? What if they lower pricing a lot, but they get way more usage? Guess what? The revenues might stay relatively equal to flat. Now, here's the kicker. They're literally missing it's anywhere from $4 to $6 billion a year in revenue they're not getting paid right now, is what they're missing. So what if all just the non-payers just pay a lower revenue rate, and then again they get hundreds or even thousands of people using their IP that never used it before because they didn't want to pay, or they didn't want to either pay, it was a non-payment of usage, or they weren't using the technology, period. Well, so what if what happens is what's the most feared case ends up generating more revenue for Qualcomm? What if Qualcomm's strategic view, their strategic positioning has been somewhat flawed? What if Qualcomm should have been charging a lower price and getting more customers? Wouldn't that be interesting? So anyway, just think about this. What if the revenues from all the non-payers and a lot more customers from a much lower royalty stream ends up being a larger chunk of revenues than they're currently getting? By the way, that's not, I did the math. The math's pretty solid. I probably won't share it. But anybody could go out there and do it. Took me a few hours over the weekend, but it's not that hard to figure out. So, we'll see. I mean, all of a sudden, Qualcomm starts getting an extra $1 billion a quarter. You know, supposedly IP is sort of super high margin anyway. So whether the price, let's just say, hey, if the price is 100 and it's high margin IP, if the IP margin's still just as high if the price is 50 or 25, it's just lower price. So that's kind of what I think. I don't know, kind of what I think could happen. I can't bank on it because I can't prove it. I don't have a spreadsheet with like 1,000 potential Qualcomm customers in it. I just kind of did. I don't know. I kind of put in like their 4 or 5, 6 biggest customers. I put what I thought were like probably the 3 or 4 biggest non-payers. Again, Apple's half the non-payer. I mean, it's basically half the non-payer dollar volume is Apple. So anyway, you wind all this stuff, and you wind all this up, and what if the bear case results in a higher revenue for Qualcomm? So okay, so they jam IP royalty rates lower, but wait, hundreds of clients or hundreds of or even 1,000 companies use their IP that weren't before, and all the non-payers pay. I don't know. It might not be nearly as devastating as everybody thinks. So we'll see. That's probably something we'll talk about in a year from now.
Well, I'm sure it's going to be something that we're going to talk about even more frequently than that, because we get asked on Qualcomm as it pertains to you in particular quite a bit. So we'll definitely
here's the
back.
thing. Okay, here's what I'm going to circle back to. Every time somebody wants to think about Qualcomm, don't forget about 11 names are removed from the focus list due to excessive price appreciation. So in other words, don't get so focused on one name that don't get so focused on a single tree that you miss the whole forest. There's tons of opportunities out there. I have tons of good trades. I have tons of good investments. Don't get yourself buried in one name. It's that simple.
All right, that's a perfect place to leave off. Perfect trading advice, perfect investing advice, and that means we will wrap this one up. Tech T, thank you for joining us today.
We did an hour and a half on this? What the hell happened?
I know, man. It's like a football game with you, man. Your 2 minutes take as long as the 2 minutes in a football game.
Well, I'm sorry. I'll try to shorten it up.
Nah, I think you'd be doing people a disservice. They like your color. So anyway.
By the way, let's not even talk football. You know, people ask me, why do I watch tennis? Why do I watch golf? Why do I watch racing? Why do I watch paint drying? That's more exciting than NFL.
Yeah, I can't say I was thrilled with.
Oh my God, that game was terrible.
Yeah.
Now, hey, don't get me wrong. I love a great NFL football game, but that was not that. That was just that was. I mean, maybe there's some people out there love super tactical defensive football. I don't. That's not my. I want to see 40. I want to see 45-37.
Yeah, I guess in a perfect world you get that. You should watch the arena football. You'll get that all the time.
Hey, that's why I watch college football. Love college football. All right. I think it's far better, more fun. Anyway, have a good one.
All right, you too, Sean. Thank you so much.
All right, later.
All right.